In this video, we're going to talk about naked calls and naked puts. Let's jump into it. So the naked put, it's basically a short put option. Now, if you remember in the previous videos, when you're short a put option, you are accepting an obligation to buy 100 shares at a certain price on or before an expiration date. It's important to see that a naked put relates to short options only. So you're probably thinking, VJ, isn't this exactly like the cash secured put? The answer is no. They're very similar, but they're not the same. Let's talk about why. So we have the cash secured put here. This is also, yes, a short put option. You are also accepting an obligation to buy 100 shares at a certain price on or before the expiration date. So up until now, it's the exact same definition between a naked put versus a cash secured put. But this is where the major difference comes from. With cash, you are collateralized, as in you have the cash to buy the 100 shares. As for the naked put, you are borrowing money. So you can actually sell a naked put without even having the cash to buy 100 shares. So if you want to look at a scale, the naked put is by far the riskiest and the cash secured put is safer. So why is this safer? It's because you actually have the cash to buy 100 shares. Here, it's risky because you actually are borrowing money to buy an asset that may continue going down in value. When you borrow money, your returns are amplified, but also so are your losses. And so when you borrow money and things go well, that's great, you're gonna make a lot of money. But when the slightest change happens and things go negatively, you're gonna lose so much more money than you may have even invested. So this is why it gets risky. Now let's continue and look at a naked call. So similarly, a naked call is a short call option. And remember, when you sell a call option, you are obligated to sell 100 shares at a certain price on a certain expiration date. Now let's compare this to a covered call. Similarly here, you're also short a call option and you're also obligated to sell 100 shares at a certain price on or before the expiration date. So everything again is exact same, but the only difference is this word naked means that you're not collateralized. So remember, the covered call, you're collateralized with 100 shares of stock. That's what this covered means. You are collateralized, like your obligations covered. As in the broker, everyone in the market knows that, hey, if you get assigned, you're covered. You have the stock to sell. As for naked calls, you are also borrowing money similar to the naked puts. This is naked because let's say you sell a call option with a strike price of $100 and the stock's trading at 140. You would be forced to sell the stock to someone in the market for the 100, even though it's trading at 140. So this means you would have to go buy 100 shares at 140, and then you'd have to take a $40 loss and sell it at 100. You would realize a negative $40 per share profit, which is pretty aggressive, right? Which you don't want to do. As for covered call, remember, same thing. Stock's at $100, it's trading at 140. You become obligated to sell it at 100, and you just miss out on the gains. But which one would you rather do? Would you rather miss out on the gains, or would you actually lose $40 per share? I'd personally just rather miss out on the gains than actually take a realized loss. And of course, if we're gonna draw the same scale, a naked call is risky. It's actually probably the riskiest, and covered call is safer, right? You can still lose money with a covered call. Basically, if the stock continues going downwards, you're going to lose money on the 100 shares of stock. But if you're bullish on the stock, it should be fine, it should recover. But if you're doing covered calls on securities that don't recover, there is risk there. As for naked calls, if the stock goes down, that's great because that means your call option expires worthless and you could close out at a profit. So let's look at naked calls versus naked puts. To even enter into these trades, you need a margin account. So you cannot do this in an IRA or cash account. So if the concept of naked calls and naked puts scare you, just have a cash account and don't open up a margin account and you should be fine. As in, your broker will literally not allow you to make naked trades. So if you don't have the cash to buy 100 shares, that trade won't even go through. And if you don't have 100 shares to sell your stock with the call option, that trade will also not go through. So these naked puts and naked calls are used for more advanced strategies, definitely not for beginners. This is the easiest way to blow up your account and lose significant amounts of money. Just know this has high risk, but you get higher return potential. And this is super important. I'm actually going to change the color so you remember this. Even though naked calls and puts have a higher return potential, you should only do this if you follow proper rules and risk management practices. So again, naked calls and puts can destroy your account if you're not using it properly. But if you do follow proper risk management techniques taught in this course, there's a lower chance that you're going to blow up your account. But you got to make sure you follow it to a T and not get carried away with emotions, because that will completely blow up your account. Okay. On this side, we have cash secured puts and covered calls. We talked about this earlier. This you can do in a cash account, or you could also do it in a margin account. But if you do use a margin account, just know that even if you don't have enough cash to buy 100 shares for a cash secured put, the trade will still go through. So with the margin account, you just need to be extra careful and make sure you actually have the cash, because your broker is not going to stop you. As for a cash account, again, your broker is going to tell you, hey, you don't have the cash, this trade is not going to go through. It is a bit safer just because everything is collateralized and you'll have less portfolio volatility. This is actually a very interesting point, because later on in this course, you're going to realize, hey, we can actually reduce your portfolio volatility through naked calls and puts, but we'll get into it later. Again, these are a little bit more advanced strategies. And so the cash secured put covered call is an incredible place to get started. But once you feel that, hey, it's time to graduate, let's do a little bit more advanced techniques to increase our risk adjusted returns, that's when we're going to jump into this. Awesome. I'll see you in the next video.